This is Laricy Live, and I'm your host, Matt Laricy. We're giving you unfiltered access to the world of real estate, where we can cover the market trends, news, and honest answers to keep you ahead of the real estate game. Laricy Live is brought to you by Lincoln Title. Lincoln Title is the best and most efficient title company in Chicago and is the best place to close your property. Laricy Live is brought to you by Guaranteed Rate and Ben Cohen. Ben Cohen is the #1 lender in Illinois and can close your loan in as fast as 8 days. All right, today we are here to discuss lending. There's a lot going on in the lending environment, so we thought we'd bring in would you say you're the #1 lender in Illinois?
Yes, I would.
We'll call him top 5.
Yeah.
Top 5 lender. Sometimes he's ranked #1. Mr. Ben Cohen with Guaranteed Rate. Ben, thanks for coming on today.
Thanks for having me, Matt.
Ben, how long have you been in the lending business? This is your second or third time on the podcast here?
I think it's our third, actually.
Third. I think it is the third time.
Yeah.
So for the people who are listening for the first time, how long have you been in the lending business?
20 years.
Okay. And out of those 20 years, would this go down as one of your top 3 worst years in your career? Minus your first year or two that you didn't know what you were doing.
I would say it's probably gone down as the toughest time in the industry.
Worse than 2009?
Way worse.
Wow.
I shouldn't say worse, just way tougher.
Why do you think it's so much been tougher?
I think interest rates going from 3% to 8%. I think home prices have not come down. I think there's no inventory on the market, so it's very competitive. You've got a lot of people offering cash. You've got an affordability factor out there right now where, a $600,000 home when rates were 3% is now like buying a $900,000 home given current rates.
On a monthly basis.
On a monthly basis.
Ben's big thing always when he tells buyers is don't tell me what you want to pay, tell me what you want to pay a month.
Correct.
Right?
Yeah, you have to look at your monthly spend because that's how we budget ourselves.
Right. And to me, I don't really think the year is that crazy bad as some other people do, like lenders and stuff like that, because I've been in a shit market because, half our business is the downtown markets and we talk about inventory levels.
Yeah.
If we're talking luxury market, we got almost 19 months of inventory, which is higher than the Great Recession, which is widely classified as the worst real estate economy of all time. So a lot of stuff that you do, since you have such a big book of business, you do suburbs, you do different states.
Yep.
And if you're selling, you do loans in Florida, right?
Every state in the union.
What's the difference in inventory in Florida than you see in like the Gold Coast in Chicago?
It depends where in Florida you're buying.
Yeah.
I mean, Florida's still a tough market. It's softening a little bit, but there's inventory issues everywhere.
Right.
I don't care if you're buying in Cleveland, Ohio. There's inventory issues.
Right. And so inventory hasn't been our problem in most of my markets.
In the city.
We've had city factors, we'll call them.
Right.
That are outside of our control, which is equally frustrating because you cannot control the government with interest rates, and I cannot control the government on what's been happening in the city.
Right.
What do you think's been different this year compared to 21 and 22?
From what perspective?
Like, what you said it's tougher. Why do you think it's tougher than 21 and 22? Is it just the rate issue? Because there was low inventory in 21 and 22.
Really? Was it like this? Well, I guess it was the same thing. Yeah. I mean, it's a rate issue for sure. People were willing to overspend for a property when rates were 3%. So, I mean, you know that, right?
Right. So you look at when the pandemic happened, and we hit record low inventory, which, by the way, for anybody that watches these podcasts, understand conspiracy theories, you go back to my COVID podcast where I did a 10-part podcast series, and I said, when everybody said the real estate market would crash during the lockdown, I said that we would see the lowest inventory in the history of the United States, which I was right on. Just want to put that out there.
You're always right, though, I feel like.
Just want to put that out there. But, we've had low inventory and we've had low rates. Now we have high rates. How would you compare this to 2019 when we had I think what were rates in 19, like 4.5%, 5%?
Yeah.
How's this year compared to that?
Before the pandemic hit, rates were 5%.
Okay, right? But how was your lending year in 2019 compared to today?
Similar.
So
from a volume perspective, it's similar. I
mean, you're coasting to 19.
Yeah, you can't compare 20 and 21. Those were anomaly years for anybody in our business.
Yeah.
So, if you're measuring yourself based on your volume or your units in those years, I just think that's not the right thing to do personally because it was artificial.
My point is, though, is when everybody's saying now it's a tough year, right? And I'm like, okay, well, if it's really tough, how's it compared to before the pandemic started? Most people I talk to say it's kind of not that much different than it was pre-pandemic.
So here's an interesting stat. In year to date, I took, I think, almost a little bit north of 1,100 applications last year. Okay. This year, today, I've taken almost 1,700 loan applications.
So it's more.
So way more. So there's a ton of people out there who want to buy. The reality is from my perception, it's either an interest rate because it's an affordability issue.
Right.
So when we get their numbers, they're like, whoa, I'm going to just wait. Or it's lack of inventory. They can't win a home. And even though my app volume is up, my production is down.
What percentage are you down roughly?
Probably 50%.
50?
Yeah, 50.
It's a big drop off.
Yeah.
How is your percent? Do you know what your percentage is down from this year to 2019?
I think I'm pretty flat, actually.
Okay. So what we're doing is we're heading back towards, and this is a big theory I've been having and I've been talking about, is that, like, we hit these crazy years. I believe real estate goes in 5-year cycles. If we were going off of that, we'd be heading to the 4th year of a 5-year cycle, which means that we're going to start seeing a change happen. And I think this year was a big year of where that change is kind of coming. We're personally down about 10 to 12% in that range, depending on how things shake out from last year. But we're substantially up from 19. We're actually up from 20 as well, but not 21 and 22. For our business, 21 and 22, I think will be like a 6 and 7 for a lot of people.
Yeah.
I feel like this, we're talking like good wine vintages,
I know.
For everybody out there, like a 9 and 10 are like your best Bordeaux. So, but how many so with you being down 50%, how many lenders do you think are leaving the business right now?
A ton. I think
would you
I
say
saw
like percentage basis, 25%,
half.
30%?
I mean, I saw, 50%. I think there were 190,000 loan originator licenses in 2022, and I think you're down to about 90,000 right now.
How does that compare to how many lenders there were in 2019?
I don't have that stat. I don't know. I assume relatively similar. I assume we still have more because, everybody and their mother and their brother and their friend was getting into mortgages because
real estate.
Who couldn't sell a mortgage when rates were 3%.
Well, I think lending and real estate were big jobs during the height of the pandemic because, one, there was a couple of Netflix series that came out that made our job look super easy and super awesome.
Yeah.
Like, we're just going out to brunch all day,
I
no
know.
stress.
I know.
Our biggest stress is like, what's that dress she's wearing at that party?
Yeah.
Right? Like, and then everybody's like, well, and then they show these commissions like, boom, boom, here
Yeah.
you go, making $1 million. And they're like, you're making $1 million. And the average American's sitting around, making, 20 to 40 bucks an hour.
Yeah.
And then they show these fictitious, which are not real, commissions out there.
Yeah.
And I think that made us look bad. I kept saying, like, these TV shows make us look bad because it's showing that we're making way too much money. They're not doing any work, and they're really not making that much commission. It's actually split in half, and then split in half again.
I know.
But it didn't look good. And for us and for lenders, I think that's part of the reason why, there's a lot of scrutiny on us right now. And I actually like this because I've been saying, like, we kind of need some shit to hit the fan for people to be like, okay, we got to get back to business for the people out there who are actually trying, So although 50% of people leave the business, that means that you have 50% more opportunity to take their business. That's why I look at it.
100%. I mean, it gets rid of all the people that are doing this part-time that shouldn't be doing it. I mean, if you're not in this, you can't possibly compete. I have people who call me and say, how do I get into this business? I mean, it's so difficult right now to crack into this business. I don't know if you'd say the same thing if somebody was, I want to get into real estate. They've got to come work for somebody like you, or they've got to come work for somebody like me that's going to teach them.
I always ask why. What's the reasoning? And 99% of the time, people tell me they want to be able to control their own schedule and they want money. I'm like, well, then this is not the business for you. So, when we talk about rates and what's the, rate, people are getting mad. Do you know what the average American interest rate is in the history of this beautiful country of the United States of America?
Over what period of time?
Just in history. What's our average?
Over the last 25 years, it's like 7.1%.
Yeah.
So we're not in too bad of shape.
Right.
We're just spoiled and ruined with artificial interest rates.
Right. So it's like, where rates are at today, people are going crazy. It's like, well, it is. And I've been saying this for about 2.5 years now. I said, well, here's the thing is that when rates go up, there's ways to make money in other areas, right? And I guess I get it that this theory would only apply to people who have kind of like a lot of extra income. So that's kind of like being an asshole by saying it. But it is true in a way that, like, a lot of my clients are wealthier bitching about interest rates. I'm like, okay, well, you could take your money and stick it in a money market right now and get like 5.5%.
I know.
And you absolutely nothing. You get 5.5% return on your money. And for anybody else out there, every dollar you make off your paycheck, no matter how much money you make, take any extra money you can, pay yourself first, put it in the money markets, making 5+%. You do absolutely nothing and you get the money back.
Correct.
When rates were 3 to 3.5%, that was like a negative return on your money. In fact, it wasn't even
Zero.
like it was like 0.001.
Yeah.
So it's like, when things are down here and they're up somewhere else, you have to try to make up opportunities and other ways to make money. So, and the other thing with interest rates is like this is a one-time purchase for most people. I work in a very volatile market where people are buying and selling all the time. Like if you're buying a house and you're going to be there for 30 years, like, yeah, your rate's going to suck for the next, could be 2 months, could be 6 months, could be 2 years. But at some point you're going to refinance, right?
Correct.
Have rates stayed at one point in history for 20 plus years straight?
No.
So they go up and they go down.
And you've never seen a run like this as going as high as you have over this period of time. So we're definitely in unprecedented waters. I mean, when you look at a bond market, if the bond market's trade, the 10-year bond's trading at 5%, the rule of thumb is interest rates are typically 150 basis points higher than that. So in theory, rates should be in the mid sixes right now, but they're not. They're pushing 8. Because of everything going on in the world, because of our credit rating, because of no buyers out there buying bonds. I mean, there's a million reasons, and just the instability in the world is causing, they don't know how to price these things. And they're worried about everybody refinancing their mortgage at the first opportunity.
Right.
Remember, there's no prepayment penalties on loans.
Right.
So you've seen a lot of mortgages now carry points.
Right.
Because they want their money up front, because they don't want to give you a loan and have it be paid off in 6 or 12 months. They let you do it,
right,
but they lose.
Right.
And the consumer doesn't understand what goes on behind the scenes.
Right.
So that's why points have become a much more common thing right now, because
what is a point for anybody
a point is if you're buying a $500,000 home and you're taking a $400,000 mortgage, you're putting down 20%, 1% of the loan amount. So you're going to pay $4,000 up front.
Yeah.
So you've got a lot of lenders out there right now quoting rates with points on them because it brings down the interest rate. I'm 50-50 on it. It depends on the break even, but on a normal standard 30-year mortgage, it's going to take you 4 years to break even on that money.
So our minus points, I know the 2-1 buy down's also been popular. Are you still a fan of that? Do you think
I
that's a good
am,
idea?
because the 2-1 buy down, so a point, what we just talked about, is a permanent buy down, right? You pay that $4,000, you never get it back. You refinance in 6 months.
Gone.
You don't get that money back. The
Right.
temporary buy down is nice because A, it gets financed into the transaction,
right,
and B, it gives you significant, when you pay a point on a mortgage, you're getting 3/8 of a point lower in rate.
Right.
Whereas a temporary buy down, you're getting 2% lower in year 1, 1% in year 2.
So essentially, a 2-1 buy down, 7% rate, you're buying it down to 5%.
Correct.
First year, second year, it's 6%,
Correct.
goes up 1%.
Correct.
And then third year, it goes up to wherever it's at.
Correct.
Unless
and
you refinance.
If you refinance within that 2 years, whatever of that money left that it costs to pay that buy down gets
get it back.
refunded back to you.
Yeah. Or
So
you put
it's
it into
great.
a loan. Right.
Well, they don't actually hand you a check. They actually just add it to your principal balance. So
Got it.
So when you go to refinance the mortgage, now in theory you owe less than what the actual balance is because they just subtract the subsidy.
Are you seeing a lot? Because I've heard there's some changes in the jumbo loans, right?
From what standpoint?
It's been I've heard a little bit more difficult to get jumbos these days.
It depends. If you're self-employed, sure. It's always been difficult to get loans when you're self-employed. So at the end of the day, you've got QM mortgages, which are your standard A paper, fully documented, W-2 employee, self-employed borrower that's been on the job for more than 2 years. So I don't think it's any more difficult, quite honestly, to get a jumbo mortgage. There's a lot more jumbo programs becoming available for the borrower who's only been self-employed for 1 year,
right.
The borrower who doesn't report a lot of money on their tax return, but they have
never
a lot of
happens.
money coming in, right? Like you look at their bank statements, we have 12-month bank statement programs where your tax return shows you make 10 grand, but we both know you make way more than that.
Right.
So we look at income, we look at expenses, and we do a calculation that way, and that's called non-QM, and that is probably the most popular jumbo markets out there right now because it's
going purely
out
off
of the
bank
box.
statements.
Bank statements. There's a 1-year P&L program out there because your P&L looks great, but then when you file the tax return is 10% of what the P&L says.
P&L is profit and loss, guys.
Yeah, sorry.
Just out there. Not everybody's financially,
self-employed people know what a P&L is.
Yeah.
So,
but the average consumer out there probably doesn't know what P&L.
I guess it's more difficult because at the end of the day, a self-employed borrower, when they go do their taxes and they file and they write off this and that, they're not thinking about how is that going to implicate me when I buy a house and get a mortgage.
Well, most people aren't thinking about mortgages until they actually apply for it, correct?
So then they get
Yeah.
the rude awakening of,
Yeah.
wait, I make all this money. Well, you're not telling the IRS you make all this money. So
Right.
that's the problem.
Yeah,
So,
and the government needs to know as much as people want to try to hide it.
the big banks probably maybe get a little tighter on jumbo mortgages from a loan to value standpoint, bigger
Yep.
equity position because of, property values and whatnot. I don't
But
know if
smaller
you feel
banks
this
aren't.
way. No, I mean, Fannie Freddie, who makes all the rules, like at the end of the day, they don't. So, banks, no matter what the kind of loan is, banks are always going to have overlays on top of what the guidelines are.
Yeah.
Okay. Which
Yeah.
is basically for everybody out there, that's a guideline on top of a guideline.
Yeah.
So there's always going to be an extra level of red tape in that scenario.
Yeah, they want to try to protect themselves as much as possible, and that's where they make the money.
Listen,
So,
and they pride themselves on that, I
That's
mean,
why banks rule the world. when,
I guess.
when the stock market crashed in the 20s, who do you think came out ahead of that,
Right.
that thing? So, speaking of this and speaking of like money terms, are you seeing more clients these days kind of like overextend themselves financially than you have before?
Well,
Like, are you seeing people like, you're like, you could qualify for 6, but you should probably be at 500, and they're like, let's just go for 600 anyways. Like, you're seeing a lot of people try to really reach more.
No. No, I would tell you the people that it looks like on paper they're reaching more
Yeah.
is they're really not reaching more because there might be a situation where, their significant other isn't employed currently right now, or their significant other is self-employed and we can't put them on the loan. So, I
Yep.
mean, at the end of the day, everybody wants to compare the market today versus 2008, 2009. And, back then, and I think we've talked about this in the past, you needed a credit score and a heartbeat
Yeah.
optional
Yeah.
back then.
Yeah. Yeah.
You could put 0% down, 100% interest only.
We're always comparing our ex-girlfriends to our new girlfriends.
Exactly.
I feel like every time anybody ever says anything, it's like, oh, that's 08, 09 again. There
So,
it is. It's just, there it is.
like at the end of the day, you have to be qualified to get a mortgage right now.
Yeah.
So you can't, they're not allowing you to overextend yourself. When I qualify a borrower and I come back and say, Matt, you wanted to spend $500,000 on a home.
Right.
You have plenty of wiggle room. If you wanted to spend 8, you could. That's a good problem to have when
Right.
you're qualified to spend
Right.
way more than you're comfortable spending.
Right.
There are people that I have conversations with that they are literally on the edge of qualifying.
Because
and
they're
it's
DTI or
and
something like
yeah,
that?
and it's like, listen, are you really comfortable spending half of your gross income on a housing payment?
What do you think is a comfortable DTI for most people? 30, 40%, 20%?
That's such a I mean, if you read online, they say they want you at like a 32%, but I don't follow those. It's because
Sure.
I don't know how you spend or save your money and what your financial goals and needs and wants are, right? There are people comfortable spending more per month because
Yeah.
they have less debt.
Yeah.
So at the end of the day, it's just what's your lifestyle.
Yeah.
I hear people say, well, if I buy this house, I'm going to have to, go out to dinner once a week instead of 3 days a week. I mean, that's not how you want to live.
Right. Right.
You
No, I
know?
agree on
So
that.
I try to tell people at the end of the day, I'm not their wealth advisor, but I have a fiduciary responsibility to make sure they understand exactly what they're signing up for.
Yeah.
So they don't put themselves in a bad position where they fire sale their unit. Now they lose everything.
Right. So speaking of that, are you seeing more loans? Are you doing more loans in the luxury market right now, or more in like the singles and doubles, I call them, where it's like $150,000 to $500,000?
All the above. I mean, I think probably more of the, the base hits, if you call them the singles and doubles, because with the higher end market, you've got people that are stuck at 3% mortgages.
Right.
And if they don't have to sell, why would they?
Right.
You don't really have a first time home buyer spending $2 or $3 million typically.
Yeah.
They're out there. They're far and few between.
I don't see them, but
yeah. the big
not in Chicago markets.
in
we'll call it.
lending,
maybe in Florida.
In lending, the big
Yeah.
push is all about home affordability
Yeah.
and all these new products where, if you're buying in Chicagoland area and you make under $140,000 a year, you're going to get a better interest rate than the guy making $200,000 a year.
Yeah, and
So-
some people are mad about that rule, but I mean, I think it's just trying to encourage, people to be able to become homeowners, which actually is a better thing for the market because then there's more transaction costs that happen, and that stimulates the economy. So, they're trying to let these people like have an option.
I think somebody told me yesterday that the housing market it stands for like 18% of the economy, right?
Wow.
So, like, at the end of the day, housing is vital to our economy.
But I mean, $140,000 a year as a salary for first-time buyer, I feel like it's high. That's a good salary.
It is. Well, they just recently changed that guideline. It used to be like $90,000.
My first 4 years in real estate, for what it's worth, I made $17,000 total. So I would have loved to make $140,000 my first couple of years.
Yeah.
Man, that'd been sweet.
Yeah.
I'm talking we're making like a couple grand a year.
Yeah.
So what do you think about these like interest rates? Do you think they'll go down in 24? Where do you anticipate that they're going to go?
I don't know. I wish I had a crystal ball for you and everybody else out there. I tell everybody when they ask me that if I could predict rates, I wouldn't sell mortgages for a living, right?
Yeah, be sitting on a yacht drinking some champagne.
Exactly. So, you read for every article that says rates are going to come down, I can show you an article that says rates are going to stay the same or go up, right?
Yeah.
You've got the Fed saying higher for longer, right? So as much as I feel like there's an opportunity that come Q1, the end of Q1, spring, I think you'll see some relief. But, you've got an election year coming.
I was going to say, what do you think about my conspiracy? I'm a big proponent that rates will plummet to mid-fives.
I don't know if they'll plummet, right? I don't think they're going to go. Listen, as high as they go up, they can fall really quickly too. But there's a lot of politics going on in the world. We've got, wars going on over the place. You've got potential World War III. I mean, so you just have a lot of outside factors. I don't think the Fed really knows.
Yeah, I don't. Right? That's why I'm convinced. Because as you go into an election and you got one party in power that's going to get crushed if you got 8% interest rates in a debate. I just personally don't see it happening. I've said this on numerous podcasts. We live in a Game of Thrones world. They're going to do whatever it takes, whether it makes sense or doesn't make sense financially. They're going to prop these bad boys down just to try to get some votes. That's just my personal take on it. It's my own conspiracy.
Yeah.
We'll see if I'm right. Keep this darn clip when it happens because I know I'm going to be right on it, but we'll see. So a couple last quick things. Refis are a big thing that people talk about all the time. You could refi. You could, it's just... I feel like it's like one of those words like just refi later. You know what I mean? Like first off, what is a refi? Like what does this entail to refinance a place? Because it is like the hot, cool button to talk about right now.
Well, it's just, there's a lot of lenders pushing, buy now, refi later, marry date the rate, marry the house.
What is it? Marry the house?
Marry the house, date the rate.
Okay.
I feel like I kind of tagged that and everybody stole it from me, quite honestly.
Should trademark it.
Listen, refinances have always been on the table. You want to know why so many loan originators are getting out of the business? Because all they did was refinance.
Chop shops.
You can't focus a business on refinances.
As
a lender.
A couple lenders that I'm friends with told me that a long time ago is that, you never really build a business off refis. And you see all these people that were making all this money off refis. They were crushing life. I saw a lot of these guys on Instagram buying Ferraris.
Oh, yeah. Crazy.
These big houses.
Crazy.
And now I see them selling their Ferraris.
Crazy,
and selling their big houses.
Yeah.
And, they're out of the business. There's a lot of businesses that have closed. And when people say, well, why have all these lending businesses closed? It's like, well, there's no more refis. All right, so
a lot of online lenders, that's all they did was focus on refinances.
What's the cost to refi a loan?
In this state, $2,800.
Okay, so how are lenders offering like free refis or cheaper refis? Like, how is that even possible?
We've always done that.
Okay.
Right? Like at the end of the day, if you're sitting at an 8% mortgage, hypothetically, and let's just say your theory's right and you think rates are going to go to 5.5%.
5.5 to 6. 5.5 to 5.9.
Let's say
5.5 to 5.9.
Let's say they go from 8 to 7. I don't care what they go, right?
Under 6.
Let's say they drop a percentage point.
Yeah.
At the end of the day, what typically happens is, so you have us that are basically waiving our lending fee and we're waiving our appraisal fee. For a refinance is if you bought within this period of time and you refinance over the next 3 years. Okay. So maybe the only thing you're on the hook for is title. Title here normally is $600-700. Okay. So not much at the end of the day, but the no cost refi is not anything new. So if you're at an 8% mortgage and now I can get you a 7% mortgage and it's going to cost you $2,800, but I come back and say, how about you take 7 1/8 or 7 1/4 and you pay nothing?
Yeah.
9 out of 10 people, 999 out of 1,000 people are going to take the option where the break even is day one and you've invested $0 up front. So can you get a little bit better rate to invest a little bit more money up front? Sure. But if you can make break even on day one, you're going to take the free option.
Yeah. I also think it's how long you're going to hold it. If you're going to hold it for another 20 years.
It's a whole economic exercise, right?
But so refis, are going to be, I think, big again. I don't think they're going to be big again, like right away. Even if they drop down to 5.5%, I don't know how many people are going to rush. I think some people want to see if it's lower, but
well, that's the $1 million question. When rates start trending, when rates start trending lower, and we saw this in the pandemic, people started getting really greedy.
They were like, "When's it going to go lower?"
They're like, "Oh, wait, I can only get 3%.
Yeah,
I keep hearing it's going to go to 2.5."
Yeah,
and then they call me 4 months later, after January 3rd of January of 2022, and now they're 4.5% overnight, and they're like, I'm like, so when it comes to refinancing, don't be greedy. Jump on the opportunity. Save your money. You never know what tomorrow's going to bring.
Right.
I mean, look at just the last 2.5 years. So,
well, the grass isn't always greener on the other side. Isn't that the famous saying?
People, you just gotta, when you have a bird in the hand, you have to take it. I mean, that's the reality of the situation.
So to wrap this up, what's your best advice for somebody that's looking to get a loan before the end of the year? What are you telling them? Here's a perfect example. I want to buy. I could buy this year. I could buy next year. What's my sway?
I mean, listen, you have to get comfortable with the payment, right? Yep. And as long as you're comfortable with the payment, and you should explore any option possible, right? Buy downs, what program do you make? What's your income level? You got to figure out what you're comfortable spending, most importantly. I've heard a lot of people say, with rates where they're at, I think I'm just going to sit on the sidelines till next year and wait for rates to come down.
Pause. I talk about this pause a lot in my weekly newsletter.
Right? So, you're probably going to echo because you probably have a better pulse on this than I do. But if I'm sitting there saying, okay, I've got all these buyers who are sitting on the sidelines and they're waiting for rates to come down, inventory is not going to get better overnight.
Correct.
Right? So what is ultimately going to happen to you when you decide to now go buy a home in April of next year because rates are now 6% from 8%?
Yeah,
it's going to be a feeding frenzy.
Yeah, exactly.
Right? So I always tell everybody, you can't refinance your purchase price.
Right.
You can't. You can refinance your mortgage.
Right.
You can't refi the purchase price. So the people that call me and say, I'm just so upset that I didn't buy when mortgage rates were 3%. I'm like, listen, people who bought when rates were 3% were paying what? 25% over the list price on the home.
Right.
So it's just however you want to psychologically digest it at the end of the day. And unfortunately, the only thing people understand when they get a loan is what's my rate. So
that's all people care about. Or I mean, for me, it's what do they care? What are they paying?
There was a $600,000 home that you would have had to pay $750,000 or $800,000 for, and you would have got 3%. But at the end of the day, it's all just a math exercise, and people just don't really understand that until they get into the weeds.
Well, the problem is a lot of people, you're only as good as your last at bat, is what I always say. And right now we got a lot of realtors, a lot of lenders, a lot of our buyers saying, well, the market's so bad. I'm like, well, last year, fourth quarter was awful. If you go back and look at it, it was terrible. And it was a really tough time. And I had a lot of buyers who are like, I'm going to wait till next year to buy till things get better. Things got better. And all those buyers got outbid constantly. And they're like, why did all these places trade for so cheap in October? I was like, well, you didn't have the balls to buy then. That's it.
Right.
Right now is deal season. You want to buy when everybody else says now is not a good time to buy. You don't want to buy when everybody says it's a good time to buy because that usually means you're too late. So if you want the best deal, you buy now. Do you have to refinance later? Sure, it sucks. But you can't change the fact that you're going to be the only one looking on the street right now compared to in March or April. Last October, we averaged 5 showings a week during the weekday and 6 on the weekend. So let's call it 11 to 12 total, okay? And once we hit February, March, and April, we were averaging over 50 showings a week and over 100 showings on a weekend. So let's call it 150 showings in a week. So think about the
Wow.
difference there, okay? And I'm a weirdo. I have all the data, so I could tell you how many showings we had today compared to last year today, compared to 2 years today, to 4 years, 10 years, etc. And I just click one button, showings, and it shows me exactly what our showings were. So, you're going to see the same exact cycle. We live in Groundhog Day, okay? The same shit happens every single year. You play the game, you win. You don't play the game, you lose. And that's it. So,
Well, and I've said this to you before, rents are real expensive, right?
that's the main reason why next year's Feeding Friends is going to be crazy. Because when you talk about inventory, right? Here's what's going to happen is that a lot of people in the markets I service are locked into a 2.1 to a 3.5% rate. They want to buy into the suburbs. Okay,
Right.
most people moving out of the markets I work
Right.
are moving to the suburbs.
Right.
We don't work the suburbs as of right
Right.
now. They go to the burbs. There's no inventory on the market.
Correct.
So they don't have anywhere to go, and then to go to where they want to go, they got to pay 7%. Even if it's 6%, they got to go there. But the house that was $800,000 in 2019 is now $1,500,000. Okay, and then their place that they live in today was worth $1 million, is now worth $600,000.
Right.
So like, well, I have to come out of pocket to sell my place and then go spend an all-time high. So then they're frozen. They're stuck. They don't know what to do. And in the meantime, the people who want to buy, they don't have as many good options. And then
Correct.
they're like, okay, well then I could rent. And then rents went from 20, and I own a huge portfolio of real estate. My one bedrooms, I got $2,200 pre-pandemic. I'm getting $2,800 post-pandemic.
Right.
And I got a line around the corner for them.
Right.
So it's like, what are your other options? You can pay a little bit more money in an interest rate, or are you just going to crush it on
and
spending money on rent?
By the way,
rent?
what's your interest rate when you rent a property?
I say this all the time. Like, they're like, well, I'd rather
It's
rent.
100.
Yeah.
It's
Like,
100%.
Well, you may lose $50,000 in a year if you sell your place, but you lose $50,000 no matter what if you rent. Like,
Right.
No matter what, it's
Right.
gone. You don't get it back.
There's
So
no tax benefit. There's no pay down on your debt.
you don't get any credit for it. I mean, again, I'm not saying that you buy a piece of real estate, it's a home run, it's the only thing you should ever do, and it's the greatest investment in the world. I'm saying that's a better investment than renting, and we have to live somewhere.
Why do you think everybody thinks it's such a horrible market?
I mean, in Chicago, I actually don't know. I really don't
Okay.
know why people say it. Like, people say it's a horrible market. I'm like, it's been a horrible market. I mean, the reason my markets are horrible solely has to do with the city problems of crime,
the safety.
safety issues,
Yeah.
lack of people going back to work. People are nervous getting on public transportation. I mean, a lot of it has to do with honestly, it's very political. The reasons why we're tough. When you talk about everybody else that's talking about the market that's saying it's difficult on the suburbs, they have inventory problems.
Yeah.
Because those people want to move out of there and go to places like Florida and Texas because they're getting out of the state because of political reasons.
Yeah.
So the red states won. I don't care which side of the spectrum you sit on, but you just
Yeah.
look at the price growth values, which it is what it is. And a lot of it has to do with things that are outside of our control, which is just extremely annoying. So, but all right, well, that's the end of our podcast here talking about lending. If you have any questions at all, please feel free to reach out to Ben. Ben, what's the best way to get a hold of you?
Ben@rate.com.
That's rate.com.
Yeah.
Yeah.
Paid
we
a lot
changed
of
from-
money for that.
Yeah. No more guaranteed rate. Guaranteed's a hard one to spell.
I told you that
Yeah,
before. Why
yeah.
everybody wants to know why we changed
Yeah.
it, and believe it or not,
Yeah.
80% of the population can't spell the word guarantee.
Yeah. Well, it's rate. R-A-T,
So-
R-A-T-E, right?
Yes,
Yeah, that's
as
it.
in a mortgage rate,
yeah,
Matt.
So,
As in a mortgage
all
rate.
right, guys. Thanks for listening to Laricy Live.
Thanks for having me.